As you all know, markets have been in free fall. In this situation, a lot of people panic and start selling off their stocks. However, this is a great opportunity to lay foundations to build your wealth. Some of the world's greatest wealth was built during market downturns. Warren Buffett made his first stock purchase during the Korean War market dip. So, in this video, we'll run through the practical tips of investing in the market during these times. Hi, I'm Aisha, an economist of over 10 years with a master's in economics and finance. Over the years, I've studied the effects of crashes and people's behaviours in response to them. And today, I'll share the insights and strategies with you. Right, first let's understand what economists call loss aversion. Our tendency to feel losses twice as strongly as gains. This explains why people make terrible decisions during crashes. A study by Dalbar found that while the S&P 500 returned 10.2% annually from 1985 to 2015, the average investor only earned 3.7% because they kept buying high and selling low. Think of it like this. If your favourite store suddenly offers everything at 50% off, you probably take advantage and buy more stuff. And that's exactly what a market crash is. A sale on stocks. During crashes, even excellent companies get sold off. Microsoft fell 45% during the 2008 crash despite having zero debt, £23 billion in cash, growing revenue and strong competitive advantages. This is what's called indiscriminate selling, when good and bad investments get dumped together. It's like a store putting Rolex watches in the bargain bin alongside cheap knockoffs. Companies with the following traits might weather this storm better. Things like having a strong balance sheet, so debt to equity ratios below 1, consistent cash flows, competitive advantages like high market share, strong brands, etc. Essential products or services, so things people need regardless of the economy. But how do you go about buying these shares while a stock market drop is happening? Some people might be thinking that they'll try and wait until the lowest point to buy. However, there is a more foolproof method. Here's where dollar cost averaging comes into play. A Vanguard study showed that lump sum investing beats dollar cost averaging about 66% of the time during normal markets. But during crashes, dollar cost averaging shines. Okay, let me explain this with an example from the 2008 crash. Imagine two investors, Lisa and Mark, each with £1,500 to invest in a company we'll call Steady Corp. Lisa decides to invest all £1,500 at once in January 2008. With shares trading at £100 each, she gets 15 shares. Mark takes a different approach. He decides to spread his £1,500 over 6 months, investing £500 each time. Here's what happened. In January, when shares were £100, his £500 bought 5 shares. Then the market started falling. By March, Steady Corp's shares had dropped to £50. Mark's next £500 now bought in 10 shares, twice as many for the same money. By June, the shares had recovered somewhat to £75, and his final £500 got him another 6.6 shares. Right, let's add this up. Mark ended up with 21.6 shares for his £1,500, while Lisa only got 15 shares for the same money. This is because Mark's strategy, that dollar cost averaging, automatically bought more shares when prices were low. But what if you already have a portfolio of stocks and shares in place with a mix of stocks and bonds? Then your question might be, what do I do with them? Here's where rebalancing comes into play. So rebalancing during crashes is like being forced to make good decisions. Here's how it works. Let's say you've saved £100,000 and decided to keep 60% in stocks, so that's £60,000, and 40% in bonds, so that's £40,000. You chose this mix because it matched your risk tolerance, not too aggressive and not too conservative. But then the market crashed. Your stocks fell 30%, dropping from £60,000 to £42,000, while your bonds stayed steady at £40,000. Now, your portfolio looks completely different. It's 51% stocks and 49% bonds. This wasn't your choice. The crash forced this change. Here's where rebalancing gets interesting. To get back to your original 60-40 mix, you need to sell some bonds and buy more stocks. Let's do some calculations. Your total portfolio is now worth £82,000. So that's £42,000 in stocks plus £40,000 in bonds. To get back to 60-40, you need £49,200 in stocks, i.e. 60% of 82,000. This means selling £7,200 of bonds to buy more stocks. Why is this so smart? Because you're essentially following the golden rule of investing. Buy low, sell high. The crash has made stocks cheaper, so you're buying more of them. When the market recovers, as it historically always has, you'll own more shares at these lower prices. This is why the Vanguard study found that rebalancing added 0.5% to annual returns over a decade. During the 2008 crash, people who rebalanced were essentially forced to buy stocks when everyone else was panicking and selling. When the market recovered, these extra shares bought at lower prices became much more valuable. The real magic of rebalancing is that it takes the emotion out of the decision. You're just following a rule. It forces you to buy assets that are cheaper than usual. It keeps your risk level consistent with your original plan. And it prevents you from accidentally becoming too conservative or too aggressive. But can you be confident about the companies you're trying to buy in times like this? There are obviously companies that might go under during these times. So, what are the indicators of a stronger company? Well, during market crashes, dividends can become important wealth builders. Here's something fascinating. Research from Hartford Funds shows that from 1960 to 2022, companies that grew or maintained dividends returned 10.2% annually, while those that cut dividends returned only 3.8%. During the Great Depression, when stock prices fell 89%, dividends provided the only positive returns for a decade. Companies that maintain dividend payments during crashes are demonstrating financial resilience, the ability to generate cash flow even in terrible conditions. Let's look at Coca-Cola. They pay dividends through recessions. They increased dividends for 60 plus consecutive years and generated positive returns during the 2008 crash through dividends alone. Reinvesting these dividends at lower prices creates a compound acceleration effect. You're buying more shares when they're cheaper, which then generate more dividends, creating a powerful wealth building cycle. Now, you may have a worry about whether these market downturns will ever regain and increase their value. So, looking at every major crash, we've seen they've been followed by new highs. Let's look at recovery periods. The 1929 crash saw an 89% fall and took 25 years to recover. The 1973 to 74 crash saw a 73% fall and took 5.5 years to recover. The 1987 crash saw a 33% fall and took 2 years to recover. And over the period 2000 to 2002, we saw a 49% fall and it took 7 years to recover. During the 2008 financial crisis, we saw a 56% fall and it took 5 years to recover. And during the 2020 COVID crash, we saw a 34% fall and it took 6 months to recover. So you want to invest and you want to take advantage of this downturn. But how do you know what companies you should be avoiding outright? Let me break down these warning signs into simple terms that could save you from major investment mistakes during these market crashes. Okay, first, imagine a company like a household. If someone has £200,000 in credit card debt, but only £100,000 in assets, you probably wouldn't lend them your money. That's what we mean by a high debt to equity ratio. When a company owes more than twice what it owns, it's a red flag. During market crashes, these companies often struggle the most because they have to keep paying their debts even when business is bad. Next, let's talk about negative free cash flow. Think of it like your monthly budget. If you're spending more than what you're earning each month, you're in trouble, right? Companies work the same way. When they're spending more cash than they're bringing in, they're like a boat taking on water. During market crashes, these companies are often the first to sink. Here's a real-world example. In 2008, Woolworths was spending more than it was making, and when the crash came, it couldn't keep borrowing to stay afloat. Within months, a British high street icon disappeared forever. Finally, the don't invest in what you don't understand rule. Remember Lehman Brothers? They were selling something called CDOs, basically complex packages of mortgages that even their own executives didn't fully understand. When the housing market crashed, these mysterious investments turned out to be worthless, and Lehman Brothers collapsed. Think of it this way. If you can't explain an investment to a 10-year-old, you probably shouldn't put your money in it. Hopefully, this has helped you make some decisions around what you can do during a stock market crash. If you want to understand more about bull and bear markets, we have this video here that can help. See you there.